Terry Teagle decided to open a small business under the name Terry's Cleaning Service on the 1st of September. During the first week of September, the business engaged in the following list of transactions, and for each of those, we're going to make a balance sheet, a very basic balance sheet, and an accounting equation at that point in time. So it's two separate concepts which are related, which is the balance sheet and the accounting equation. So let's look at the balance sheet. We've got a big T on the page. We put the assets on the left-hand side, and we put the liabilities and owner's equity on the right-hand side. And when we total them up, both sides have to equal. Assets must equal liabilities plus owner's equity. So, for instance, if we had a $20,000 car with a $5,000 loan, that would give us capital of $15,000, and both sides would equal $20,000. And what backs up the balance sheet is what's called the accounting equation. And that says our assets must always equal liabilities plus owner's equity. So if we took that for an entire business, we could say the assets are $100,000, liabilities are $40,000. Well, that must mean the owner's equity is $60,000. It's also true for every individual transaction. So whether we bought a $20,000 vehicle with $15,000 cash and $5,000 on account, we'd have an asset called vehicle going up, $20,000. We'd also have an asset called cash going down, $15,000. And we'd have a liability called accounts payable or creditors going up $5,000. And just looking at that transaction, we've got assets going up 20 but down 15. That's an increase of 5,000. Liabilities went up 5,000 and owner's equity weren't affected. So the two sides equal assets equal liabilities plus owner's equity. So that's whether it's a business as a whole or each individual transaction. Let's get started with this business that we've been given the data for. September the 1st, $9,000 was deposited by Terry in a bank account to commence business. So let's do the accounting equation bit first. Assets are going to go up $9,000 called cash. And when you give the business money, that's called a capital injection or a capital contribution. So owner's equity called capital would go up $9,000. No effect on liabilities. Putting that into a balance sheet, we'll put the cash on the left-hand side for $9,000. We'll put the capital under owner's equity for $9,000. Total each side, and we get $9,000 on each side, so our balance sheet is in sync. The next thing that happens is bought cleaning equipment for $2,000 cash. So first thing that happens is we've now got a new asset called cleaning equipment, and the second asset goes down called cash, and that's it. What's interesting with this one is it doesn't mean every single item in the balance sheet in terms of assets, liabilities, and owner's equity has to be affected. It just has to balance overall. So we can see if we just take it back a step, assets go up 2,000 but down 2,000. That balances to zero. This is zero and this is zero. So that actually does balance. All three items have a balance of 0, 0, 0. So we can now go into our balance sheet. There's our balance sheet from the day before. That's what it did look like. We've got to add in the cleaning equipment. So that's an asset. So we add that in under the cash. We've also got to decrease cash 2,000. So it was $9,000. It's going to go down to 7,000. We total it up. The total is actually going to be the same. It's still going to balance to $9,000. September the 3rd, the firm purchased office of furniture on credit from Robert's Office Furniture for $1,700. Putting in the accounting equation, assets went up $1,700 called office furniture, but that was on credit, so we're going to have a liability called creditors or accounts payable go up $700 and no effect on owner's equity. Putting that in the balance sheet, there's the previous day. We're going to update that by putting in an asset called office furniture. And we're going to get our first liability called accounts payable or creditors, you can call it either. And now we need to retotal our balance sheet, and if we do the asset side, we get $10,700. If we do the what's called the equity side, which has liabilities and owner's equity together, we also get $10,700. September the 4th, the firm borrowed $5,000 from ELC Finance Company. Gone and got more money, so an asset called cash has gone up, but that's come with a liability or an obligation to pay the bank back, in this case ELC Finance $5,000, and there is no impact on owner's equity. Here's the balance sheet from the day before. Let's update it. The first thing is we've got more money, so cash needs to go up from $7,000 to $12,000. And we need to add in a new loan called, or a new liability called loan to ELC Finance Company. Let's add up the balance sheet and retotal. If we retotal those assets, we get $15,700. And if we retotal the equity side, we get a total of $15,700. September the 5th, Terry withdrew $800 for personal use. That's called drawings. That's where the owner takes out their capital. So the business has less money, so the asset called cash goes down. And the other effect is owner's equity called capital also goes down because the owner is withdrawing their capital. No effect on liabilities with that transaction. There's our balance sheet from the previous day. We'll update that by decreasing cash by $800, so it goes down from $12,000 to $11,200. And then owner's equity or capital needs to go down $800, so it was $9,000, so we better decrease that to $8,200. Let's add up the two sides. We've got assets equal $14,900, and the equity side also equals $14,900. September the 6th, a payment was made to a creditor, Robert's Office Furniture, for $300. The impact of that transaction is the cash of the business, which is an asset, goes down $300. And the other impact is we're paying back a creditor or an accounts payable. So the total of accounts payable is going to go down too by $300. There is no impact on owner's equity with this transaction. There's our balance sheet from the day before. We're going to update that. Going to decrease cash from $11,200. That'll go down to $10,900. And the accounts payable figure needs to go down from $1,700. It's got to go down by $300 to $1,400. Retitle the balance sheet on the asset side, we get $14,600, and if we do it on the equity side, we also get $14,600. September the 7th, the firm sold some of the office furniture purchased on the 3rd of September and received $300 cash. So what we've got more of is an asset called cash that's gone up $300. But to do it, we've had to give up another asset called office furniture, which has gone down $300. There's no impact on liabilities or owner's equity here. So again, that's a transaction where the assets go up and down by the same amount. That balances to zero. We've got zero in liabilities plus zero in owner's equity. So the accounting equation does balance in this case. There is the balance sheet from the day before. We're going to update that. We're going to increase cash by $300. We need to decrease that office furniture figure downwards from $1,700 to $1,400. Retitle the balance sheet. It'll actually be the same number because the asset side went up and down by the same amount and the equity side hasn't changed.